Download this code from codegive.com, link in the description below. OK, let's dive into the world of joint arrangements under IFRS, specifically focusing on joint operations, formerly known as jointly controlled operations. This tutorial will be detailed and include code examples to illustrate the accounting treatment. We'll break it down into sections for clarity and ease of understanding. What are joint arrangements? Joint arrangements are arrangements in which two or more parties have joint control. Joint control is the contractually agreed sharing of control of an arrangement, which exists only when decisions about the relevant activities, those activities that significantly affect the returns of the arrangement, require the unanimous consent of the parties sharing control. Types of joint arrangements *. IFRS 11 identifies two types of joint arrangements. 1. Joint operations *. The parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities relating to the arrangement. 2. Joint ventures *. The parties that have joint control of the arrangement have rights to the net assets of the arrangement. This tutorial will primarily focus on joint operations. Part 1. Understanding joint operations. A joint operation is essentially a collaborative effort where parties agree to share control over a specific activity but retain rights to the assets and obligations for the liabilities. Each joint operator uses its own assets and resources and is directly responsible for its own obligations. Key characteristics of joint operations *. Direct rights and obligations *. Joint operators have direct rights to the assets held in the joint operation and are directly responsible for the liabilities. This is the defining characteristic. * No separate entity, usually often, but not always, a joint operation is not conducted through a separate legal entity. Even if there is a separate legal entity, its legal form does not lead to separation of the legal liabilities of the participants from the arrangement itself. * Unanimous consent required * Decisions about the relevant activities require the unanimous consent of all parties sharing control. * Each party bears their costs and receives their share of revenue. * Joint operators bear their own expenses and receive their agreed share of the revenue generated by the joint operation. No investment in the joint operation itself. * Joint operators do not have an investment in the arrangement because they do not have rights to the net assets. Examples of joint operations *. Pipeline sharing * Two oil companies sharing a pipeline to transport crude oil. Each company pays for its share of the operating and maintenance costs and receives revenue based on the oil it transports. Research and development, R&D, project * Several pharmaceutical companies collaborating on developing a new drug. Each company contributes resources and expertise and receives a share of the revenue generated if the drug is successful. Co-development of a property * Two construction companies jointly developing a large real estate project. Each company contributes resources and receives a share of the proceeds from the sale of the properties. Accounting for joint operations, the core principle. A joint operator shall recognize in relation to its interest in a joint operation. Its assets, including its share of any assets held jointly. Its liabilities, including its share of any liabilities incurred jointly. Its revenue from the sale of its share of the output of the joint operation. Its share of the revenue from the sale of the output by the joint operation. Its expenses, including its share of any expenses incurred jointly. In simpler terms, each joint operator accounts for the assets they bring to the joint operation, the liabilities they incur, the revenue they earn, and the expenses they pay related to the joint operation, including their proportional share of any jointly held or incurred items. It's as if they were doing these activities directly, themselves. There is no investment in the joint operation that needs to be accounted for. Part 2, Joint Operations, Practical Application with Code Examples. Let's consider a scenario. Scenario *. Alpha Corp and Beta Incorporated enter into a joint operation to operate a toll road. Alpha Corp provides the land, and Beta Incorporated provides the construction expertise. They agree to share revenue and expenses 60/40, Alpha/Beta. The toll road is jointly operated. Year 1 transactions *. Alpha Corp incurred operating expenses of $100,000. Beta Incorporated incurred operating expenses of $150,000. Jointly incurred marketing expenses, $50,000. Toll revenue generated, $500,000. How Alpha Corp and Beta Incorporated would account for this *. Alpha Corp's accounting *. Assets *. The land contributed to the operation remains on Alpha Corp's balance sheet, accounted for under the appropriate standard, example IAS 16, property, plant, and equipment. Expenses operating expenses, $100,000. Share of jointly incurred marketing expenses, 60%. $50,000 equals $30,000. Revenue share of toll revenue, 60%. $500,000 equals $300,000. Journal entries, Alpha Corp. Beta Incorporated's accounting *. Assets Beta has no asset contributions. Expenses operating expenses, $150,000. Share of jointly incurred marketing expenses, 40%. $50,000 equals $20,000. Revenue share of toll revenue, 40%. $500,000 equals $200,000. Journal entries, Beta Inc. Important considerations and complexities. 1. Jointly controlled assets *. Sometimes, the joint operation holds assets that are jointly controlled. In this case, each joint operator will recognize its share of the assets on its balance sheet. For example, if Alpha and Beta jointly purchased a piece of machinery for the toll road, each would recognize their proportion of the machinery's cost and depreciation. 2. Jointly incurred liabilities *. Similarly, if the joint operation incurs liabilities, each joint operator recognizes their share of the liabilities. For example, if the joint operation takes out a loan, each operator recognizes their proportion of the loan liability. 3. Sale of assets to the joint operation *. Profit or loss *. If a joint operator sells an asset to the joint operation, the selling operator will recognize the profit or loss only to the extent of the other operator's interests. The portion of the profit or loss related to the seller's interest is deferred until the asset is sold to a third party by the joint operation. Example Alpha Corp sells equipment to the joint operation for $50,000. The equipment's carrying value on Alpha's books was $30,000. Alpha's share in the JO is 60%. Total profit, $50,000 to $30,000 equals $20,000. Profit recognized by Alpha immediately, 40%, $20,000 equals $8,000. Profit deferred by Alpha, 60%, $20,000 equals $12,000. The $12,000 is recognized when the JO sells the equipment to a third party. 4. Purchase of assets from the joint operation *. Asterisk profit or loss asterisk if a joint operator purchases an asset from the joint operation, the purchasing operator will recognize its share of the profits or losses on the asset only when it resells the asset to an independent party. The portion of the profit/loss that relate to other ventures is recognized immediately. Asterisk example asterisk the Joe sells product to Alpha Corporate for $80,000. The cost of this product to the Joe was $50,000. Alpha's share in the Joe is 60%. Asterisk total profit equals $80,000 to $50,000 equals $30,000. Asterisk profit deferred until Alpha sells the product to a third party equals 60%. Asterisk $30,000 equals $18,000. Asterisk profit immediately recognized by Beta, the other venturer 40%. Asterisk $30,000 equals $12,000. This gets recognized by the Joe and therefore ultimately impacts Beta's earnings. 5. Capital contributions asterisk the contribution of assets by a joint operator to the joint operation does not usually give rise to a gain or loss, unless the asset is sold at a price different from its carrying value, as discussed above. Instead, the asset remains on the contributor's books at its original carrying value. 6. Distributions from the joint operation asterisk cash distributions from the joint operation are typically treated as a reduction of the operator's accounts receivable from the joint operation, or simply as cash received that is recognized as revenue. 7. Disclosure asterisk joint operators must disclose the nature, extent, and financial effects of their involvement in joint operations. This includes disclosing the amount of each of the assets, liabilities, revenue, and expenses related to its interest in the joint operation. Part 3, Transitioning from jointly controlled operations, under old IAS 31, to joint operations, under IFRS 11. Before IFRS 11, jointly controlled operations were accounted for under IAS 31, interests in joint ventures. The transition to IFRS 11 can have significant implications. Asterisk reassessment asterisk entities need to reassess their existing joint arrangements to determine whether they are now classified as joint operations or joint ventures under IFRS 11. Asterisk change in accounting asterisk if an entity was previously using proportionate consolidation, allowed under IAS 31, for an arrangement that is now classified as a joint venture, it must discontinue proportionate consolidation and instead use the equity method, as required for joint ventures under IFRS 11. This is a major change. If the arrangement is still classified as a joint operation, there will be no impact on the accounting. Asterisk retrospective application asterisk IFRS 11 is generally applied retrospectively, which means entities need to restate their prior period financial statements as if IFRS 11 had always been in effect, subject to certain exceptions and practical expedients. Summary of accounting treatment for joint operations. Item accounting treatment. Assets contributed remains on the operator's balance sheet. Jointly controlled assets, each operator recognizes their share of the asset. Liabilities incurred, each operator recognizes their share of the liability. Revenue, each operator recognizes their share of the revenue. Expenses, each operator recognizes their share of the expenses. Sale of asset to Joe, profit/loss recognized only to the extent of other operators' interests, remainder deferred. Purchase of asset from Joe, profit/loss recognized only when the asset is resold to an independent third party by the buyer, remainder deferred. Key takeaways asterisk. Asterisk joint operations are about direct rights and obligations. Asterisk each joint operator essentially accounts for their activities as if they were their own. Asterisk understanding the rules for sales to and purchases from the joint operation is crucial. Asterisk disclosure is important to provide transparency to financial statement users. This detailed tutorial should provide a strong foundation for understanding joint operations under IFRS 11. Remember to always refer to the official IFRS standards and related guidance for the most up-to-date and accurate information. I recommend practicing with more examples to solidify your understanding. Good luck.